Most people buy insurance because they are required to, not because they understand what they are buying. Auto insurance is legally required to drive. Health insurance is often obtained through an employer with limited decision-making involved. Renters and homeowners insurance is frequently required by a landlord or mortgage lender. The result is that most people are paying for insurance products they do not fully understand, making coverage decisions without a clear framework for evaluating them, and either overinsured in some areas or dangerously underinsured in others. This video builds the foundational understanding of how insurance works as a financial tool, and then covers the 4 types of insurance most people encounter in their daily financial lives. Insurance is a risk transfer mechanism. When you purchase an insurance policy, you're transferring the financial risk of a specific category of loss from yourself to the insurance company in exchange for a regular payment called a premium. The insurance company pools premiums from a large number of policyholders and uses that pool to pay claims when covered losses occur. The system works because most policyholders do not experience a large loss in any given period, which means the premiums collected from the many are sufficient to cover the claims paid to the few. From your perspective as a policyholder, you're trading a known, manageable cost, the premium, for protection against an unknown, potentially unmanageable cost, the covered loss. The fundamental logic of insurance is that it is worth buying when the potential loss is large enough to cause serious financial damage that you could not absorb from your own resources. A loss that would wipe out your savings, put you into significant debt, or permanently alter your financial trajectory is a loss worth insuring against. A loss that you could cover from your emergency fund or normal cash flow without lasting financial damage is generally not worth insuring against, because the cumulative cost of premiums for that coverage will typically exceed the expected value of the claims you would file over time. This framework, insure against catastrophic or severely damaging losses, self-insure against smaller losses you can absorb, is the rational basis for insurance purchasing decisions. Several terms appear across all types of insurance and are worth defining clearly before moving into specific product types. The premium is the amount you pay for coverage, typically monthly or annually. The deductible is the amount you pay out of pocket on a covered claim before the insurance company begins paying. A higher deductible means lower premiums and higher out-of-pocket costs when a claim occurs. A lower deductible means higher premiums and lower out-of-pocket costs at claim time. The coverage limit is the maximum amount the insurance company will pay for a covered loss. Anything above the limit is your responsibility. The copay is a fixed amount you pay for a specific covered service, most commonly in health insurance. Coinsurance is a percentage of costs you pay after your deductible has been met, again most common in health insurance. The out-of-pocket maximum is the most you will pay in a given period, after which the insurer covers 100% of covered costs. Health insurance is the most complex and consequential type of insurance most people deal with. In the United States, health insurance is obtained through an employer-sponsored plan, purchased individually through the federal or state marketplace, obtained through government programs like Medicaid or Medicare, or in some cases through a parent's plan up to age 26. The core function of health insurance is to limit your financial exposure to medical costs, which in the United States can be extraordinarily high without coverage. A single emergency room visit can cost several $1,000s. A hospitalization can cost tens of thousands. A serious illness or injury without insurance can produce medical debt that takes years or decades to resolve. When evaluating health insurance plans, the primary variables to understand are the premium, the deductible, the out-of-pocket maximum, the network of covered providers, and whether the plan type is an HMO, PPO, or high-deductible health plan. An HMO, or health maintenance organization, typically requires you to choose a primary care physician who coordinates your care and provides referrals to specialists. Care outside the HMO network is generally not covered except in emergencies. HMOs tend to have lower premiums and lower out-of-pocket costs, but less flexibility in choosing providers. A PPO or preferred provider organization allows you to see any provider without a referral, both in-network and out-of-network, though out-of-network care costs more. PPOs offer more flexibility, but typically have higher premiums. A high-deductible health plan commonly called an HDHB, has a higher deductible than traditional plans, but lower premiums and is paired with eligibility for a health savings account, which provides significant tax advantages for covering medical expenses. The Health Savings Account, or HSA, deserves specific mention because it is one of the most tax-advantaged accounts available in the entire financial system. Contributions to an HSA are tax-deductible. The money grows tax-free, and withdrawals for qualified medical expenses are tax-free. This triple tax advantage makes the HSA uniquely powerful for people who can afford to contribute to it without immediately drawing it down for current medical expenses. HSA funds roll over indefinitely and can be invested after a certain balance threshold, making them a vehicle for building a tax-free reserve for future healthcare costs, including in retirement. Auto insurance is legally required in almost every state in the United States, though the specific minimums vary. The legal requirement is typically for liability coverage, which covers damage you cause to other people and their property in an accident. Liability coverage does not cover damage to your own vehicle or your own medical expenses. Most policies are expressed as split limits. For example, $100,000 per person, $300,000 per accident, and $100,000 for property damage, meaning those are the maximum amounts the insurer will pay per person injured, per accident for all injuries combined, and for property damage respectively. Beyond the legally required liability coverage, most drivers also carry collision coverage, which pays for damage to your own vehicle in an accident regardless of fault, and comprehensive coverage, which covers damage to your vehicle from non-collision events including theft, weather, vandalism, and hitting an animal. Whether to carry collision and comprehensive depends on the value of your vehicle relative to the premiums and deductibles. On a vehicle worth less than a few $1,000s, the annual cost of collision and comprehensive coverage may approach or exceed the value of the vehicle itself, making it financially irrational to carry those coverages. On a newer or more valuable vehicle, carrying comprehensive and collision protection is generally worth the cost. Uninsured and underinsured motorist coverage protects you if you are in an accident caused by a driver who either has no insurance or whose insurance limits are insufficient to cover your damages. Given that a significant percentage of drivers on U.S. roads carry only minimum liability coverage or no coverage at all, this protection is valuable and typically inexpensive to add to a policy. Renter's insurance is one of the most underutilized and cost-effective forms of insurance available. Many renters assume, incorrectly, that their landlord's insurance covers their personal belongings. The landlord's insurance covers the building structure and the landlord's liability. It does not cover your furniture, electronics, clothing, or other personal property in the event of theft, fire, water damage, or other covered losses. Renter's insurance covers your personal property, provides liability protection if someone is injured in your apartment, and often covers temporary living expenses if your unit becomes uninhabitable due to a covered event. The annual cost of renter's insurance is typically between $150 and $300 per year, making it one of the most affordable forms of meaningful financial protection available. Life insurance exists to replace income and cover financial obligations for people who depend on you financially in the event of your death. The primary function is to ensure that your dependents, a spouse, children, or anyone else who relies on your income, are not left in a financially devastating position if you die. If you have no dependents and no one relies on your income, the financial case for life insurance is limited. If people depend on your income, life insurance is not optional. There are two fundamental types of life insurance: term life and permanent life. Term life insurance provides coverage for a specific period, typically 10, 20, or 30 years, and pays a death benefit if you die within that term. If the term expires and you are still living, the coverage ends with no payout. Term life is straightforward, relatively inexpensive, and appropriate for most people whose insurance need is tied to a specific period of financial obligation, such as the years during which children are dependent or a mortgage is outstanding. Permanent life insurance, including whole life and universal life, provides coverage for your entire life and includes a cash value component that builds over time. Permanent policies are significantly more expensive than term policies and involve complexity that makes them difficult to evaluate. For most people without specialized estate planning needs, term life insurance is the appropriate product. The amount of life insurance coverage you need depends on your specific financial obligations and the income replacement needs of your dependents. A common starting point is 10 to 12 times your annual income, though a more precise calculation considers your outstanding debts, the number of years your dependents will need income support, and any other specific financial obligations like a mortgage or college funding. An insurance needs calculator can help you arrive at a more tailored figure. Making informed insurance decisions requires understanding what you are buying, what it covers, what it does not cover, and what the realistic cost-benefit calculation looks like for your specific situation. Insurance is not an investment and should not be evaluated as one. It is a cost you pay to transfer specific financial risks. Paying that cost for risks that genuinely threaten your financial stability is rational. Paying it for risks you can absorb yourself is not. Building a clear picture of your insurance coverage across all categories, understanding the gaps, and making deliberate decisions about where additional coverage is warranted is a foundational component of a complete personal financial system.